Hey guys, and welcome to another YouTube lesson. Today we're going to be taking a look at processes. It's the second lesson of process of financial management. And again, I reiterate, it's a big word there, surprised I can say it. We're taking a look again at making sure we know our four business functions. It's very important. HR, finance that we're doing at the moment, operations and marketing. And again, inside of a business function, apart from HR, where there's five, with finance there's four parts. We've done the role of financial management, the influence of financial management, and the process of financial management. I should have that pinky down. Okay, so these are the set of steps that a financial manager, when we talk about processes, goes through to complete their jobs. All right, now this lesson will be taking a look at this notion, this syllabus dot point of monitoring and controlling. And in particular, we're looking at cash flow statements as a tool, and don't look at me when we say tool, a tool to monitor and control. Now, in future lessons, we're also going to be looking at monitoring and controlling over the next two lessons, but we'll be looking at income statements as a tool to monitor and control, and balance sheets as a way to monitor and control in the final of this trilogy, if you will. That's right, Lord of the Rings style. Now, monitoring and controlling. What is it? Monitoring is the observations made to see if something is being done correctly. Booyah. Okay, i.e. monitoring is the process of measuring actual performance against planned performance. And that's one of the textbooks, their definition, and I want you to be able to quote something like that. Now, budgets, cash flow statements, income statements, balance sheets, when reviewed or looked at by financial managers, are examples of monitoring. All right, now as I said before, how's it a process? It's important you understand why it's an influence or a process. It's a process as is something that all financial managers need to do, or should be doing anyhow. All right, now controlling, that's the next part of this dot point. Controlling is acting upon the information obtained during the monitoring process. Very insightful. i.e. controlling is the comparison of planned performance against actual performance, similar to monitoring, but now you're taking corrective action to make sure the objectives are obtained. Okay, so taking that corrective action. So if a financial or a finance manager sees an error or a concern with, say, a cash flow statement, and then they act upon it, this is controlling. All right, so an example, if there's a shortage in cash flow during the month of July, and a cash flow statement, is looking at money coming into your bank, money going out of your bank, and seeing whether you're in the black, sweet, okay, you're in the positive, you're in the red, negative. So in this example, there's a shortage of cash flow during the month of July, and you've got brackets there, which is minus 1,000. The monitoring is the financial manager noticing this by reviewing the cash flow statement. When they use a strategy, a particular strategy such as maybe distribution of payments throughout the year, then they're actually controlling. Now, cash flow statements, it's one of the syllabus dot points, and it's one of the key tools to be able to monitor and effectively control the finances of a business. All right, using a cash flow statement, as I said, is just one way to do this. In essence, a cash flow statement looks at the cash and other financial inflows and outflows of a business over a particular year. Often you'll see in HSC questions, trial exams, it's over the whole year, but it's done monthly. And you look at January, February, March, April, struggle remembering my months then, that's a problem. Okay, now it calculates how much money is left in the bank account at the end of each month, the start of each month and the end of each month. If there's a negative or minus amount, then the business has potential liquidity issues, cash flow issues, problems. Now, kids get confused big time between working capital and cash flow. Okay, now they're both short term, and that's where the problem arises. All right. In terms of working capital, we're looking more at a balance sheet. And we're taking a look at, that's my mum again, I must be popular. We're taking a look here at with working capital, your balance sheet, current assets compared to current liabilities and that liquidity or current ratio, does the business have enough current assets in relation to their current liabilities? This is not cash flow. Okay, this is working capital. With cash flow, I want you to think of your bank account, your business's bank account. Do you have money in your bank account? If you're looking at your financial, your statement, your printout, say minus 500 or plus 2K. If it's in the plus, you're sweet. If not, you've got not working capital issues, you've got cash flow issues. All right. Now, in terms of cash flow, as I said, and a cash flow statement, I want you to have in your mind that bank account. Let's run through it a little bit and I'll explain it greater in class. So you have an opening balance of, say, $1,000. So in your bank account, $1,000. Then you have cash sales or receipts, which might be, say, $400, put into your account. There's money coming in your bank. Then in that same month, you have money going out of your bank. Let's say it's $200 in the form of bills and so on, just expenses coming out of your account. Then I want you to try and calculate how much money is left in your account at the end of the month. Just give you a second to think about it. Let's say it again. $1,000 was in there to start. You got $400 of cash sales placed in there through that month of, let's say, January. Okay, then $200 came out. This is not brain surgery. I can do it and I suck at maths. How much money is in there, left in there at the end of that month? Let's call that month that January month. It could be March, April, whatever. 1,000 to start, 400 coming in, minus 200. My maths is correct. Just doing it again to make sure. You should have $1,200, $1,200 left in there right in the last second of January, if you're looking at that month. Now, what is there at the end of the month, the very last second, carries forward to the very start of that next month, February, if we're using that January, February as an example. So you start with $1,200. Then you take a look at money coming in for that month, money going out for that month, and what's left over at the end. At the very last second of, in that instance, would be February. What's there at the very last second of February with the very first second of March? It carries forward. That's how we do it. We'll do some examples in class. All right. Now, in terms of cash flow management, we talked about the monitoring, which is what I'm kind of looking at there. We're now looking at the controlling aspect, some strategies that can be used to improve cash flow. And there's plenty, and these are ones you must use direct from the syllabus. We have distribution of payments, discounts for early payment, and factoring. Now, let me explain these quickly. Distribution of payments is like spreading payments throughout the year. So I do this myself with my house insurance, home and contents insurance. So if the place burns down, please burn down. If my place burns down in your house, I could pay it once, all at once, probably like $1,200. That's a fair bit of coin to just come out on that month. Or I could pay it monthly. $1,200 in a year, you're paying instead per month, even I can do that, about $100. Okay, and therefore it's smaller, manageable amounts, less likely to really chunk in to your account, and therefore less likely to leave you in the red, in the negative. There's other things that you can do called discounts for early payments. Here, a business who may have a poor accounts receivable turnover ratio. Okay, that means people aren't giving them, they're not paying their own accounts payable, your accounts receivable. You could offer your clients, because I'm Bunnings in this instance, my carpenter that's coming and buying from me, or my plumber, or whatever it may well be, he or she, those bastards, they're not, shouldn't say bastards, those buggers, they're not paying on time. But if I give them an incentive, a little bit of sweetness, a bit of cashola, a bit of a discount for paying early, then they're likely to pay their accounts payable, my accounts receivable, and that's cash coin coming into my bank account, especially at times when it would have been in the negative. Last one, similar concept, it's factoring. Here, I will outsource my accounts receivable to a factoring company, like a debt collector, I suppose. They'll then pay the business the balance my business, the balance of the accounts receivable, and that third party will chase up the accounts themselves. This provides the business, I'm Bunnings, me, with an immediate inflow of funds, thus improving my cash flow. Because again, if I was to go into the red, factoring is a way to get some of that cash that I'm owed, but people aren't paying me, into my bank accounts. All right. Thanks, guys, for listening. And again, we'll be taking a look at the other financial statements in future lessons. See ya.